Imagine a world where um, a big tech company's promise to pay you back is seen as safer, like more reliable than an IOU from the U.S. government itself. Sounds kind of like science fiction, maybe, but that right now is where we're starting.
It really is. It's probably the most startling signal the bond market has given us in decades. It's a pretty clear warning sign, that the basic rules of global finance, they're changing fast.
Yeah, because of these deep shifts in the U.S. economy and, well, rising geopolitical risks.
Exactly.
We've done a deep dive into a whole stack of analyst reports, economic research, and honestly, the findings are dramatic. So our mission today is to connect four huge related topics that are really defining what's coming next. We'll kick off with that really bizarre bond market thing, Microsoft bonds yielding less than U.S. Treasuries.
Then we need to look at this massive disconnect, potentially dangerous disconnect, between overall U.S. GDP growth and the profits, the soaring profits of the S&P 500.
Third, we're going to talk about the official start, like government-mandated start, of a multi-year defense supercycle. It's being driven by this huge push for missile production.
And finally, we'll break down the four interconnected geopolitical threats that our sources say are forcing the U.S. onto what they're calling a quasi-war industrial footing right now.
Okay, let's unpack this then, starting with that bond market signal that has everyone scratching their heads, the safety paradox.
Right. So traditionally, U.S. Treasuries, they're the global risk-free asset. That's the benchmark.
Because the government can always print money,
Right.
right? Theoretically.
Theoretically, yeah. They can always pay their debts. Corporate bonds, even from giants, well, they're riskier. A company can go bankrupt no matter how big.
But now, this is wild. Our sources are showing Microsoft bonds, corporate bonds, are trading at a lower yield than U.S. Treasuries. And not just short-term stuff. Across intermediate, even long-term bonds like the 5-year and 10-year.
Hold on, let's just make sure we land this really clearly for you, the listener. A lower yield means investors are actually willing to accept less return on their money.
Because they think it's safer.
Exactly. They view that asset as fundamentally safer. So why? Why is the safety calculation totally flipped? Why take less money from Microsoft than from the U.S. government?
It's like finding a safe deposit box at your neighbor's place that you trust more than the main vault at the Fed. Just feels wrong. And you said it's not just Microsoft.
We're seeing it pop up with Apple, too, Johnson & Johnson sometimes. It's this category of ultra-stable, cash-rich companies.
So what's that signal about the government then?
Well, it signals deep, growing distrust in the U.S. government's financial stability. Plain and simple. Reason number one, the big one, the debt and deficit crisis.
Yeah, the numbers are staggering.
U.S. national debt is now over $40 trillion. Debt to GDP ratio, nearing 130%. The market looks at that and basically says, how do they actually service this debt long term? Microsoft, on the other hand, massive cash flow, huge reserves, a fortress balance sheet, basically.
Okay, that makes fiscal sense. But is the political climate also, spooking bond buyers?
Oh, absolutely. The market is definitely factoring in more political risk now. Sources point specifically to concerns about, well, political unpredictability. Things like the potential for reigniting global trade wars, maybe through universal tariffs or Section 232 actions under President Trump. That kind of uncertainty. It creates real economic instability that makes investors nervous about government debt.
And inflation's still sticky, right? That must play a role.
That's the third piece, yeah. Persistent high inflation has kind of trapped the Federal Reserve. They raise rates too aggressively, they could crush the economy. But if they cut rates, they risk inflation taking off again. It's a dilemma.
So in that unstable environment.
In that unstable macro picture, a company like Microsoft, which dominates AI and cloud, has pricing power. They can pass inflation costs to customers, keeping their cash flow stable. They just look, frankly, safer than the government's ability to stabilize the whole economy right now.
That stability, that seems to be the key word. Because what's really fascinating here is this core idea, U.S. Treasury equals risk-free asset. It's breaking down. If the safest asset now carries real credit risk in investors' minds, how does that change the game for investing?
It changes everything. I mean, decades of financial wisdom kind of go out the window. Investors can't just blindly buy treasuries anymore, assuming zero risk. They have to analyze U.S. debt for credit risk, just like they do with corporate debt. And this is leading to the rise of these ultra-premium, AAA-rated corporate bonds as, wait for it, the new safe haven.
A new safe haven. Wow.
Yeah, investors are making a rational calculation. I'll take a slightly lower return for what feels like more fundamental corporate stability, and to avoid all that sovereign political and fiscal mess.
Okay, so financial stability is concentrating in these megacore. That idea of concentration. That leads perfectly into our next puzzle piece, doesn't it? Why is the performance of those corporate giants totally decoupling from the rest of the U.S. economy? Let's get into segment two, the decoupling mystery.
Yeah, the latest data is really jarring. U.S. nominal GDP growth, it slowed quite a bit in Q2 2025. Traditionally, that should mean corporate profits slow down too.
Right, they usually move together.
But nope, S&P 500 operating profit margins are near all-time highs. And this gap, this divergence, has pushed the forward price-to-earnings ratio, the PE ratio, above 24.
Okay, 24 times forward earnings. Historically, that's really high. The market's betting big on future profits that the current GDP numbers just don't seem to support. The old playbook seems useless here. Why? What's ripping up the rulebook?
It really boils down to two main forces: AI and extreme profit concentration. First, AI is enabling what some analysts are calling costless growth.
Costless growth, what does that mean?
Well, think about it. For decades, if a company wanted, say, 10% more revenue, they usually needed maybe 7% higher costs, more staff, more buildings, more marketing spend. Now, AI leaders, your NVIDIAs, Microsofts, Googles, they're investing heavily in AI infrastructure, sure, but then they can achieve massive revenue growth without equally massive increases in operating costs.
Because the AI does more of the work.
Essentially, yeah. Their profit margins can accelerate almost exponentially because they don't need to scale up hiring or physical presence in the same old way.
Okay, that's AI. And the second reason you mentioned was concentration.
Exactly. The high S&P 500 profit margin. It's less about broad economic health and more of a trick of the eye. It's driven overwhelmingly by the Magnificent Seven.
Big tech giants.
Right. They're so dominant in cloud, AI, digital ads. They have immense pricing power. They can raise prices, maintain margins, even when other sectors struggle. Their success basically pulls up the average for the whole index, masking weakness elsewhere.
So the S&P 500 isn't really a mirror of the U.S. economy anymore.
Less and less. It's becoming more like a global tech hegemon alliance index. The U.S. economy might be slowing, but these seven giants are winning globally, and that's what the index reflects now.
Okay, hang on. If the stock market index reflects global tech dominance more than U.S. economic health, then using traditional macro indicators like GDP or unemployment to make investment decisions becomes, well, it's a trap, right?
It absolutely can be a trap. Investment success now seems to depend much more on microanalysis. Forget the big picture telling you everything. You have to really dig into individual companies, focusing on what analysts call profit quality. Meaning companies that have successfully used AI to cut costs and have the market power, the dominance to raise prices. And this whole phenomenon suggests maybe these high PE ratios aren't just a bubble. Maybe they're the new normal if AI fundamentally changes how much profit companies can sustain over the long term.
Wow. Okay. That shift towards concentration, dominance, and this systemic risk.
You're
It gets even starker when we pivot to the huge geopolitical shift our sources flagged. The new defense supercycle. We're moving from spreadsheets to missiles now.
Yeah, this isn't just talk anymore. The U.S. military production drive is now formal, it's aggressive, and it's legally backed. It went from calls for more munitions to concrete action when President Trump signed the Defense Production Act, the DPA, Title III, on September 26th. And this specifically targeted the production of 12 key missile types.
The DPA, that's a big deal, right? It lets the government force companies to prioritize defense contracts over commercial ones.
That's exactly right. It's a powerful tool, almost like a wartime measure. And it wasn't just the order. It was backed by a huge bipartisan $50 billion emergency supplemental budget.
$50 billion. Okay, that signals serious commitment.
And that money immediately triggered massive investment from the industry. Lockheed Martin, for example, announced $1.5 billion just to expand their production lines for JSSM and LRASM missiles. RTX, formerly Raytheon, is putting in $2 billion to quadruple their Patriot missile production capacity. They need to hire 2,000 new workers, like yesterday.
And our sources also mentioned this isn't just about the old guard, the traditional defense primes. They highlighted some newer players.
Yeah, companies like Anduril are being pointed to as potential game changers. The government sees them as critical because they're focused on AI-driven missile tech, counter-drone systems. They approach it with modern software development, aiming for efficiency gains beyond just building faster assembly lines. It's clear the U.S. knows it needs both sheer quantity of the traditional stuff and that cutting-edge, software-defined defense tech.
So for you, the listener, what does this aggressive ramp-up really mean? It sounds like this isn't just a temporary blip in military contracts. Our sources are calling this the official start of a structural supercycle that could last 5 to 10 years.
That's the absolute key takeaway for investors. You need to look beyond just the prime contractors, the Lockheeds, the RTXs. You need to examine the entire value chain underneath them.
Meaning the suppliers.
Exactly. This cycle creates huge sustained demand for sub-suppliers. Think specialized sensors, processors, solid rocket fuel, unique chemical components, special metal alloys. And also look at the efficiency providers, the companies making industrial robots, automation systems, even the 3D printing firms that can make complex metal parts faster and potentially cheaper.
Okay, but a production ramp up this fast, driven by urgency, it has to hit some snacks, right? There must be risks.
Oh, absolutely. Two major risks jump out immediately from the source material. First, what they call defense inflation. This sudden surge in demand could drive up prices for critical raw materials, specialized components that could actually squeeze contractor profits down the road. Second, persistent supply chain limits. We still rely heavily on certain countries, including potential adversaries like China, for things like rare earth elements or the advanced chips needed for these sophisticated missiles. That's a vulnerability.
Which takes us right into our final segment, understanding the urgency. Why? Why is the U.S. forcing this complex, expensive, potentially risky military-industrial transition right now? What's driving this immediate need?
Well, the sources lay out four interconnected, pretty serious threats driving this. The main one, the pacing challenge, as the Pentagon calls it, is China, specifically the Taiwan scenario.
The potential conflict over Taiwan.
Right. War games consistently show that in a fight over Taiwan, the U.S. would basically burn through its current stockpile of key precision weapons like the JSM and LRS-M missiles we mentioned in just a matter of weeks.
Weeks, wow. Way faster than we can make them now.
Far faster. So it's not just about having better tech. It's about having the sheer quantity of long-range precision missiles needed to counter China's A2AD strategy.
Their anti-accessory denial bubble,
Mm-hmm.
designed to keep U.S. forces out.
Exactly. To break through that bubble, you need overwhelming numbers of long-range weapons. Threat number two comes from very recent, very hard lessons from modern warfare, especially Ukraine.
What did that teach us?
It proved the rate of attrition, just how fast missiles, shells, drones get used up, is enormous in modern conflict, much higher than planners expected. It showed that our decades-long focus on just-in-time defense supply chains, built for efficiency, is inadequate for real war. We have to shift to a just-in-case approach, which means massive stockpiles. Current production just can't keep up with wartime consumption rates.
And defense planners. They always have to prepare for the absolute worst-case scenario, don't they?
And that's threat three, the multi-front risk. Planners are genuinely worried about simultaneous conflicts erupting. Think Europe, the Middle East, East Asia, potentially all at once.
3 fronts at the same time.
That's the nightmare scenario they have to plan for. And the analysis is stark. Our current stockpiles aren't even sufficient for one major extended conflict, let alone 2 or 3. So the mandate is clear. Increase production capacity by 2, 3, even 4 times current levels. It's seen as non-negotiable.
Okay, and finally, there's just the practical reality. The time it takes, which makes the DPA necessary now.
Yes, threat 4 is simply industrial constraints. Even with the money approved and the DPA signed, building and scaling new production lines takes time. A lot of time. Getting the supply chain sorted for things like rocket motors, finding the skilled labor, securing the specialized semiconductors. Sources say that takes 24 to 36 months, minimum.
2 to 3 years just to get new lines running smoothly.
Right. And there's a strategic calculation that the real danger zone for major conflicts could start around 2027 or shortly after. So the urgency is about starting today to be ready for that critical window. They can't afford to wait.
Okay, so let's try to wrap up this massive deep dive. We've covered the breaking of old economic rules, the death of the risk-free bond, the divorce between GDP and corporate profits. These aren't just weird quirks. They're signals of deep structural changes, driven by AI's power and, well, major geopolitical risk.
And if you connect the dots, these financial paradoxes like Microsoft versus Treasuries and this big shift to a quasi-war economy, they're both consequences, really. Consequences of, first, extreme U.S. fiscal imbalance, just runaway debt, and second, this growing concentration of power. Whether that power is economic power in the hands of a few huge tech firms or political power driving industrial policy through mandates like the DPA.
So what does this all mean for you, the listener, trying to navigate this? The government's solvency concerns, shown by this weird bond market inversion, might be the first real cracks appearing in the whole idea of dollar hegemony. If the traditional safe haven isn't truly safe anymore, where do you put your money for genuine stability? If this bond thing keeps happening, what are the long-term impacts on the US dollar's global status? And should you maybe be looking at non-dollar safe havens, things like physical gold maybe, or even other stable currencies like the Swiss franc for your own portfolio? That's your assignment, your homework for further thought.
Yeah, a really critical question to ponder in what feels like a permanently changing financial landscape.
That's it for this deep dive.